throughout and at the end, and we will make sure that you have them on hand. So with that being said, I'd like to introduce our two panelists today. Ahmad Farouk is the Senior Vice President, Head of Retail ETF Investing at Franklin Templeton Investments. And Veronica Popova is the Director of ETF Strategy at CI Global Asset Management. So welcome to you both. So we're going to jump into questions right away. And so Ahmed, let's start with you. Somebody wants to make an investment. How would you start? Where would you start looking for an advisor?
Thank you, Pat, and thank you for having me here today on this panel. I think it starts with, for all of us, is that probably the most safest place where we kind of feel comfortable going is probably the bank that you already have a relationship with, somewhere where you're already doing you have a checking account and savings account. And one of the great things there is the ability to ask them for advice on different, if you want credit cards, if you want a mortgage, if you want a line of credit. Usually when you walk into a bank, there's those individuals that are on the sides or within glass walls, and those are essentially the customer service representatives that will take you in and kind of help you decide on how far you want to go within the kind of the banking system. Usually they're there for simple investments that you may have questions on, but if you want to take it a little step further and you have goals or you want to invest for certain things, and they may move you up to a financial advisor, and they would kind of go through a questionnaire with you to kind of figure out what type of investments make sense for the needs that you're looking for. And the way that banks work from a perspective of investments is that as you have more money to invest with them, there are hierarchies in terms of what you can get from them. So going through the bank channel, it's usually the customer service representative will do simple investments, and then the next level will probably give you a financial advisor. Most of them will probably invest, let you invest in some of their balanced products, which are essentially a mixture of fixed income and equities to give you kind of a balanced approach. And that will be predicated on a questionnaire that you fill out on figuring out what your risk levels are, what your time horizon is, and what you want to do. If you have about $250,000 to invest, then the next level will be at a brokerage house where the 5 banks or the 5 major banks in Canada all have an attached brokerage house. So if you bank with RBC, it'll be Dominion Securities. If you bank with TD Bank, it'll be TD Waterhouse or TD Wealth. Scotia will be Scotia Wealth. BMO will be BMO Nesbitt Burns, and CIBC will be CIBC Wood Gundy. Once you get there, kind of the sky's the limit, because I mean, once you kind of have the threshold limit, then you can look at different types of investments such as stocks, mutual funds, ETFs. There's all different platforms that could be used, and again, it'll be all based on what you're trying to accomplish with that investment. So that's in one direction. The banks also have a different direction. For example, if you don't want an advisor and you want to do it yourself, so there is a direct channel where essentially you can go in and purchase whatever you'd like for a fee, like a commission charge on the transaction. You can go in that direction. And I would say the last direction you can look as for an investment is a robo-advisor, which essentially that you don't want to talk to someone in real life, but you want someone to kind of help you, guide you where you need to be. And these are usually all app-driven, questionnaire-driven. And once you kind of figure out where you are, you can start setting it up through an app-based platform. You put there's no forms. It's all done through an app, and they can help you go in that direction. So I would say there's a lot of different directions, but from a safe place where you're probably not knowing where to go, I would probably go to your local bank and ask them for advice, and they can put you in the right direction. You're on mute.
I know. I was trying to unmute before you said it. If somebody wanted to have an advisor, but they're choosing not to go to their bank, what options do they have?
So I guess I can take that one. So as Ahmed mentioned, there's a lot of different options outside of just having an advisor, in addition to robos and DIYs, but a lot of these platforms are also available from non-banks. So in Canada, I would say the banks are definitely the key players, and everyone has is familiar and knows them very well. But we also have a lot of other wealth management firms out there, or even asset managers that sell financial products, but they don't offer the advice. So they sell and manage ETFs and mutual funds, which you can buy yourself on those DIY platforms. Other DIY platforms that aren't affiliated with banks, you may have seen ads for Questrade, Wealthsimple, and those platforms not only have DIY investing, but they also have robo-advisor services as well. So if you've seen ads for Questrade and they talk about providing advice and services in that on that front, it's their robo service, which is essentially it's auto allocating your assets among the different investments and managing it for you, and you don't have to touch it at all. The good thing about a face-to-face interaction with an advisor, if that's something that you prefer, if you're not as financially savvy, if you need someone to help guide you more, if you have a lot more complex goals when it comes to children and education planning, estates, wills, tax planning, things like that, especially if you're maybe self-employed. There are other financial advisor firms out there as well, wealth management firms. Typically, you can find them anywhere. There's a lot of different names that come to mind. CI actually has a branch called Asante Wealth Management. That's just to name one out there, but many others out there other than the banks. So don't think that banks are your only option. Advisors aren't your only option. There's many others out there. I would say getting to know it, almost interviewing the different advisors and different firms. Like you could even walk into your bank, ask a couple questions, get familiar, and then maybe do the same, you know, do a couple Google searches, find a couple other firms and see what works for you and what you feel most comfortable with. Another thing that I know, especially for newcomers to Canada, I actually immigrated to Canada myself. Something that my parents found really helpful was finding an advisor that spoke the same language as them. So, you know, that's also available on different websites. If you can, they often specify the languages that they speak. So maybe that's something that you can look into as well. And yeah, I feel like there's a lot to talk about there. Could go in a lot of different directions, as Ahmed said, but just so you know that those options are available to you.
Great. So now, Veronica, we've got an advisor. We've chosen one through the processes that you've both spoken to, and I sit down with them. How do they know what I need or what I want in an investment?
Right. So once you do get to meet those advisors, and as you're interviewing them, they're going to be interviewing you as well. They're going to be asking you questions to get to know you and pretty much how they can help you. So they obviously need to know your personal financial information. They need to know your income, your spouse's income, and any other sources of income that you may have. Any children or dependents that you have, because that's obviously going to affect how you can save your money, what your risk levels are. They might ask you certain questionnaires to get to know your financial literacy, how savvy you are with financials. I have friends that don't know what an ETF is and that have all their money in a checking account, and I'm on the opposite spectrum, of course. So different levels of financial education are obviously out there, and that's what advisors are, you know, there to help you with. They'll also ask you questions that relate to AML, so anti-money laundering, to ensure that the money that is coming in is legal money, of course. That's something that's very important when you're placing money into the financial system. Just depositing cash all the time, obviously that can be a red flag for the banks, and they want to know that the money that you're depositing is legal tender. They'll also ask you questions in relation to your time horizon. So obviously different ages and different stages of your life are going to determine what kind of investments and what kind of goals you have. For someone that is later in age, and you know, children are above the age of 18, you're in your 60s, you might have very low risk investments. So that's why they need to know what your time horizons are and what your goals are. On the other hand, if you have someone that's earlier in their 20s or 30s, their priority is maybe buying a house. They don't have any children yet. Maybe they want to set up for save for things like a wedding, for example. And that actually takes me into the point of they're going to want to know the priority of your goals. So you may want to buy a nice car in a couple of years or pay for a wedding, as I mentioned, but obviously retirement and paying for your children's education is more important, unfortunately. So these are all the types of questions that they're going to ask you. They're known as KYC questions, know your client. And again, all of these questions may get a little personal, but it's only for the purpose of knowing you and getting to know where they can put you in the investments. As Ahmed mentioned, banks often sell what's called balanced funds, which is a equal, almost mix of equities and fixed income. But then there's obviously funds that are maybe higher risk and higher equity versus funds. As I mentioned, if you're later in age, closer to retirement, you're going to have not so much balance, you're going to have a lot more fixed income and lower risk investments. And yeah, I guess I don't want to take away from the rest of the presentation, so I'll just stop there.
Yeah, I was just going to add one thing that I was going to add from that is that just like we interview for a job, I mean, this is a job that you want them to have for you. So just make sure that you don't settle on the first advisor. Like Veronica said, like maybe you want to test out one that speaks the same language as you, or this, or come from the same culture, so they understand your cultural needs versus just your financial needs. Then you can try someone that is a little bit different than what you're normal. But I would say just try to put in perspective of what you're looking for and try to make sure that you cover maybe 1 or 2, 3 people. Just because then you know that you're not settling, but you're actually getting the best that you think that will help you get to where you want to be.
Great. So to continue on that discussion, Ahmed, if I sit down with my advisor and we've walked through my goals, are there different strategies or product is probably not the right word, but ways of saving for a house or children's education that the government and the regulators have set up?
Yeah, this is a good one because I think sometimes we forget to look at what the government offers as examples to help Canadians plan for their future, if it's for education for their children, or if it's to buy your first home in Canada. One of the things that we have that I took advantage of when I graduated from university and I was looking for a home is the home buyers plan. This is a great plan that's available to all Canadian citizens, where if you have money in a registered retirement account, you can actually pull up to 35 grand out of that and put that as a tax-free, I mean, it's pulled out tax-free, but also is a 0% interest loan that you can take on your behalf, and you can start to invest that into your house. The only caveats, I mean, obviously, if nothing's ever free, is that you have 2 years to start repaying that back, and it's you got to pay back within 15 years. So you do 1/15 every year, and you pay that back into your account. The only downside is that 35,000 was not invested while you were buying your home, so you lose out. You could potentially lose out on performance or that 35,000 appreciating in value just because the fact that it's out, but it's in your home. But it's really good because at times where you're looking to make other purchases as you want to furnish your home or you want to buy things, and this could be an extra bonus to the mortgage that you're looking to get, or you can get a lesser mortgage with that 35,000 as long as you have that money in your registered account. The other thing is that the government has, which is really good, is the RESP plan, which is the Registered Education Savings Plan. This is really good because this is not just a parent. It could be a grandparent. It could be an aunt and uncle. It could be a family friend. It could be anybody that wants to help your child get an education that has a vested interest. And the way the government has it is that you can put up to $50,000 as a maximum per child, and up to $2,500 a year, you will get a 20% grant. So the government will give you free money as an incentive for you to help fund your child's education. Inside of that program, it's tax-free as well. So once you're invested in there, it's tax-free. So there are these plans that are out there in terms of trying to help you start with educational, but also with home buyers plans. And there's also a tax-free savings account, which I think is something new that came out recently. Not recently, has been around for a while, but this allows you to invest your money without paying tax, but you have the ability to take that money out. The only thing is that if you take that money out, you have to wait a year to put that money back in. and there are limits that you can put in per year. But the great thing is that it won't affect your registered plan, which is supposed to be deferred until retirement. This allows you to get access to it quicker. So if you have money and you want to invest your money into a stock or a mutual fund or an ETF, as Veronica mentioned, then this is the ability you can do that. You can do that through an advisor. That you can open a tax-free savings account or an RESP account or a home buyer's plan. You can do that through the bank system. You can do it through outside the bank system, and you can also do that through a robo-advisor or a discount where you're going direct and you're doing it all yourself. So these types of capabilities are available in all ways, in all types of functions based on what's out there to help you invest your money, but also help you guide you to where you want to be for your goals in your life.
Great, thank you. So now I'm with my advisor. I've figured out how I'm going to save and in what vehicles. Veronica, how do the investment products that go into each of the portfolios, how do they get selected? How do I know they're the right ones for me?
So again, this question can go into so many different directions, but to start, okay, so you have your accounts, and I would say even amongst all those accounts that Ahmed mentioned, I wouldn't say there's only one right one. You're probably going to have a mix of different ones depending on your situation, your tax bracket, your income, when you need the money. As Ahmed mentioned, TFSAs let you take it out sooner. So you might have a mix of all of them, and that might also determine which investment products go into each one as well. But that's more of a conversation with your advisor or whoever you're speaking to, depending on your situation. But once you have those accounts, what products you'll likely see in there is a mix of potentially ETFs or mutual funds, depending on the account, the advisor. But before we get into what ETFs and mutual funds are, I guess we can start with what those ETFs and mutual funds actually hold. So typically it could be a bunch of different asset classes, but mainly you're looking at stocks and bonds, which many of you may already be familiar with. A stock is essentially a share of a corporation or a company, or is known as an equity. And then a bond or fixed income is actually a loan from an investor to a borrower, such as a company or a government. And the borrower, whether it's a company or a government, is using that money to fund its operations. And for you loaning them that money or lending them that money, you're receiving interest on that investment. So in that sense, fixed income or bonds are typically more lower risk because it has a more steady, almost guaranteed income. And then the equity portion is obviously higher risk because you're investing in a company, you're investing in the stock market, and that equity can be, domestic equity, so Canadian companies. You could be buying U.S. equities like Apple, Tesla, Microsoft, or it could be international equities. It can go on. And in that sense, ETFs and mutual funds are you can think of a basket of all of those stocks and bonds. Now, I also want to mention that ETFs and mutual funds can also hold other asset classes like commodities, derivatives, currencies, cryptocurrencies, pretty much anything that you can invest in. I'm sure there's a mutual fund or ETF out there that invests in it. But to keep things simple, so you have your basket of, let's say, stocks that an ETF is invested in. So that ETF doesn't just buy random stocks and bonds. It'll essentially buy what it's meant to buy, depending on the strategy that it's focusing on. So as I mentioned, you could be buying let's say, a Canadian equity, Canadian stock ETF. That Canadian equity ETF won't be buying Apple or Tesla. Those are US companies, right? So in that sense, your portfolio will be made up of a mix of all those different, let's say, ETFs or mutual funds, or even single stocks or fixed income securities, depending on how you plan to invest your money, if you're doing it yourself, how the robo's investing for you, or how your advisor's investing for you. And typically, you'll have a mix of that equity and fixed income ETFs or mutual funds that will be either lower risk, so may have a lot more fixed income in there, or they may be higher risk. If you're younger, you have a longer time horizon, you can handle, dips in the market if there are any. You'll be in a higher risk portfolio that is a lot more equity than it is fixed income. So that kind of mix, I guess, is based on, as I mentioned, the questions that your advisor will be asking you to determine your risk tolerance, your time horizon. All of that kind of goes hand in hand. Also, if you have any specific stocks or bonds or ETFs that you want to invest in, you can also mention that to your advisor. As I mentioned, you can have a portfolio of ETFs, but you can also be holding single stocks as well. So all of those allocations kind of make up the piece of the pie, or they're all pieces in the pie that is your investment portfolio. And as I mentioned, you can have different accounts. You can have your RSP investing in certain things. Your TFSA might be lower risk securities because it's money that you want to be able to take out whenever, versus your RRSP has a longer time horizon, so you may have more equities in there. Also, that ties into the tax advantages of certain underlying investments as well. But again, that's something that you can discuss with your advisor depending on your tax situation, your tax bracket, and the actual assets that you're holding. I also want to mention, aside from those, you may also hear about through the branch channel, GICs or high yield savings accounts. So those are typically, you kind of just park your money. It's almost like cash. A GIC is a guaranteed investment certificate. So a bank will often sell those, and it's guaranteed money because you're investing, you're locking in that money, and you're receiving that money back with interest in X amount of years or months, however it pays. The only downside is, as I mentioned, the money's locked in. And then you have a high yield savings account. So at your bank, you may have your checking and your savings accounts. So your savings account is paying you interest, but it's a very, very small amount. So typically we don't recommend, just keeping all your money there. But yeah, happy to answer any additional questions on this when we get into the Q&A portion, because as I said, this is, I feel like, a lot and different education levels. So yeah, I'll leave it there.
So I'd like to just dig deep a little bit on that, Ahmed. Could you just walk us through, I mean, you're going to work with an advisor and they're going to select products for you and invest for you. Can you give us the different options on how an advisor would get paid?
Yeah, that's a great question, because a lot of times you think they're working for free because there's no money being transacted. So you go in there, they make use of the immaculate plan, and you walk out and you're like, well, wait a second, like, how, is the bank paying his bills? And I think that's all dependent on what level of advice you're getting and at what level of how much money you have to invest. If you go through the bank branch, they are paid a salary, so they're getting paid irrespective of what they provide to you. They're getting paid base salary and so forth. So this way you kind of look at it that they're not trying to shove products down your throat, but they're just more about making sure that they have different targets, obviously. If you go up the level to a financial planner, they could get paid on commissions, which means that every conversation they have with you, they get paid on the transaction costs of helping you move into a certain product. And sometimes those types of, I would say, way of investing has kind of gone away. The banks felt that sometimes commissions are too expensive, but also sometimes are they making you move to different products just because they need to make up higher commission costs? So the most banks have gone to a fee-based structure, where what they do is they charge you a fee based on the amount you invest. And with that way, you can have, some of them will say, based on your asset base, that you can trade with me maybe 10 times a year or 15 times a year, depending on the firm. Some may be unlimited based on how much money you have invested. The great thing about fee-based investing is that if you have a non-registered account, you can actually write off that fee. So that there's some positives to that too, where on a registered account you cannot, but on an investment account that is non-registered where it's not tax deferred, you can actually write that cost down when you're filing your taxes. The next, I would say, the next evolution from fee-based has been discretionary fee-based. So as Veronica kind of alluded to, where mutual funds and ETFs are a bundled securities, but they're managed by somebody. They're managed by a portfolio manager. And what we've done in Canada, but also in different parts of the world, is that we have given the title of portfolio manager to the advisor. And what that means is that advisor can now transact on your behalf based on the mandate that you've purchased or based on what the goals and what you've decided with him. So him versus he or her calling you to tell you that we're going to make this transaction the old school way, which we commission, he and her calling you to get your permission to make changes during a fee-based way, a discretionary would do those transactions on your behalf. And why that is beneficial is that if, for example, they can't get a hold of you, maybe you're in a work meeting, or maybe you're traveling, or maybe you're not available at the time when the markets are moving in a positive or in a negative direction, and they got to make some changes. They got to take some profits, or they got to raise some cash. Or so discretionary manager will do all that on your behalf, and they will manage your portfolio based on the risk levels that you propose within your policy statement, which is what they got to stay within the guidelines. Now, the great thing about this is that it's not that you lose control. They will probably tell you, they probably send an email after the fact or give you a call and say, hey, just so you know, there was something that happened in the marketplace today and we made some subtle changes in the portfolio, and we're just letting you know that you're going to receive some statements that say that these some transactions have occurred in the portfolio. That's where probably the world is going, in that direction. Some may feel that are there any rules and regulations when you do it that way, which means that they're doing a lot of transactions without my permission. And what you'll find is that in this method, it's actually the risk levels from a bank perspective are actually tighter, because since you are making transactions on your behalf, then there's a lot more guardrails that are in place by the banks in terms of compliance to ensure that they're not doing things that are outside of what you signed up for. And usually that's the most important thing. So I think in that direction, that's where larger brokers or investment advisors that work in the brokerage houses, but the ones you deal with at the bank will not be able to do that. They will only be doing they're going to be only salaried based, potentially commission based. They will be able to, they'll have to call you to make those. So there's a natural evolution, but I would say as you kind of work up the hierarchical ladder based on how much assets you need to invest, then it becomes a lot more sophisticated, but also sophisticated in your benefit.
Thank you. Veronica, both of you have touched on, how you select an advisor, you interview them, you have the relationship. Going forward, what should an investor expect from the advisor? How often do they call? Do you get statements? What kind of information? What does that look like? I know there's going to be variances, but what should be sort of the minimal expectation for an investor?
So that's actually a good point as well. So once you meet your advisor, and as Ahmed mentioned, some of them may not call you to let you know about changes. However, you should be calling them to let them know about any changes in your financial situation. If there's anyone in your family that passed away and you've taken on a large sum of money that alters your financial situation or position, that's something that you should let them know. If your child is no longer choosing to go to college or university and they no longer need that money, that's another big financial change, another change in your financial position. So you should be calling to let them know about any changes like that. However, I would say on a yearly basis, you should be reviewing your portfolio. Does this make sense? Sitting down with your advisor. So outside of that yearly review, you should be, connecting if there are any significant changes. However, your advisor will also be sending you statements, whether it's monthly, quarterly. You could most likely be able to log into your account and see that as well. Now that everything's digital, you don't have to wait for statements. You're free to see that as well. But yes, I would say typically, if you're not hearing from your advisor, you should be at least sitting down once a year to review, make sure this makes sense, see how your investments are doing, connect with the advisor to see what changes they did make in the past year. I know that's something that I do with my advisor. We take a look at the past year, the changes that they made, what they'll be doing going forward, anything like that. Because I'm in a discretionary account where my advisor's not calling me to let me know about changes. But as I mentioned, I'm also checking up on my own account and seeing what they're doing online as well.
Ahmed, one of the channels that you both spoke about in terms of allowing or an investor using is the robo or the self-directed. Where could somebody get all the information that they need on the products that they want to invest in? Because there are over 1,000 ETFs and multiples of that of mutual funds and other stocks. So where can they get the information that even if they have an advisor that they can read and get a better understanding of the products?
So from a sorry, from a direct channel, it kind of changes. Sorry, I got my allergies are kicking in. Not COVID, but allergies. The thing is, like, when you're going direct, and direct meaning that you are bypassing an advisor, sometimes the onus falls pretty much on you to do the research on what you want to buy. There are some investors that sign up for investment clubs. They follow certain blogs to kind of help them, guide them. Obviously, for those that follow the financial markets, there's been these meme trades or Reddit trades where people kind of fall into these groups and they start taking advice from people they don't know, and they start buying things. So the risk is a lot higher, because one of the things you'll find out with if the markets are moving in opposite directions and you miss out on getting out, this is where the advisor would come in and help you versus you trying to. So to get product information, you got to do the research. And there's been some good sites. The Pat's website, SETFA, has a screener that you can look at some of the ETFs that are out there. The TSX, the Toronto Stock Exchange, has an ETF screener which will kind of give you some information. Morningstar is a really good website where you can do both research on mutual funds and ETFs. The NEO Exchange in Canada also has a really good website where they can take a look at what's available. But one of the things that comes down to is that you got to do a lot more work to find out what's best for you. I recently presented at the Money Show, and this is kind of the shows where you kind of get ideas on what type of products are out there. But also, I think if you're looking for higher risk strategies, I mean, you're going to have to do that due diligence. From a robo perspective, it's a little different. I think once you kind of do the research on the types of the robo advisor that you want to work with, and one of the ones that you probably saw some commercials on have been Wealthsimple, which are on TV quite often. They all have different programs based on how you fill out your KYC, which Veronica talked about, your Know Your Client. This questionnaire that you go through will dictate which products should work best for you, but also based on the minimum of the number of assets. Because I mean, even in robo channels, if you have more money to invest, those portfolios can get even more customized, because obviously the bare bones will start at a different level, and then the customizations will go up as you have more money to invest. Again, this goes back to when I mentioned the kind of hierarchical system investing, which it's not good, but it seems that the more money you have, the more things you can do. But the good things is that these programs that are set up, even the bare bones, that do extremely well. And I wouldn't look at it that you need more money to get better, because sometimes when you have more money, you can have more things that can go wrong, just because you have too many levers you're pulling up and down. While if you keep it to the basics, which you can do that with ETFs, which a lot of these robo advisors use, are usually just plain Jane products. They're just buying very basic exposures to the Canadian market, the US market, the international market, the emerging markets. They're using more broader exposures to the bond market. Yes, the customization could be how much Canada versus US, how much international versus global. And that customization can also come in as you move up the ladder in terms of investing. But I think the onus when you don't use an advisor comes on you. And just like when you are researching that nice TV that you want, you got to do the same time and put in when you're looking for that. And I think a lot of us tend to spend a lot more time researching that curtains that you want to put in your house, or the car, and or that TV that you're looking at to put in your main room. But do we spend enough time and invest the time to do the research when we're doing it for our future? And I think that's a very important thing that we got to think about, and put that at the same level of researching that you're doing for other things for your future.
You spoke about the levels of investing. What's the minimum that somebody can have before they can start investing?
I think through the bank channels and through Robo, there's no real minimums as long as there's a PAC. So PAC is a periodical like monthly payment that goes in. So if it's $200 a month, $400 a month, or whatever you sign up for, when you want to get the customization, the banks may have a minimum of 50,000. I don't know what that number is. Each bank is different. So like I said, interview. When I bought my home, we had real estate agents dropping off cards like, hey, call us. But when I did call them, I called all 5 of them, and I had them sit in my house all separately, and I asked them all the same questions, and I picked some of that. Just got to find out what bank works for you, what investment style. I think at the brokerage houses, the minimum has now gone up to 200,000 to 250, depending on the $250,000 of investable assets, in order to be able to talk to a full service broker, which is an advisor that has the ability to sell stocks, mutual funds, ETFs, SMAs, which are separately managed accounts, alternatives. So you kind of get, you're kind of in the grocery store now, picking all different types of ingredients to build your recipe, versus in a bank, you only have 1 or 2 ingredients to build that recipe.
Great,
If
thank
I could
you.
also add to that, actually, Ahmed, I love your analogies because I always use that when people ask me, like, why would I buy an ETF? I can pick my own stocks. I do a better job, whatever it is. And I tell people, well, you wouldn't perform your own root canal on yourself. So why would you invest your money yourself if you have the financial literacy and you're savvy in that sense, and you have a good financial background, by all means, go ahead. But for someone that isn't experienced in that, and you're really just buying stocks based on what you're reading on Reddit blogs or what are high performers historically, a lot of the time you're not going to outperform a mutual fund or an ETF, which is managed professionally by investment professionals, people that do this for a living, that have the economies of scale to buy broad stocks and fixed income bonds. And the thing is, even if you are able to outperform and pick the right stocks, if you're some sort of investing genius, majority of the time, the cost that you have to do this yourself, because trading does come with fees, and especially if you're having to buy and sell constantly, it won't beat out the low fees that are offered by those that are managing your investments for you. So just wanted to add that in there as well.
Yep. No, that's great. And I know I'm throwing some questions at the speakers because of what they're saying, to make sure that we're clear. One of the things we've talked very broadly about products that can be invested in, and you've talked about different areas and sectors. One of the things that is in the papers, I almost want to say daily, but it's certainly weekly, is ESG. And so this is a bit off topic, but because it's always in the press, I'm wondering if Veronica or both of you could just speak to a little bit about ESG investing, given that it is such a popular topic that's out there, that people really need to understand why they would want to invest in ESG. So Veronica, maybe we can start with you.
Sure. I wouldn't say I'm an ESG expert, and I know because it is so talked about right now, and it is such a hot topic, and there are so many investments that are now becoming ESG, there's so many different definitions for what ESG is. So I don't want to give the wrong one or anything, but broadly speaking, ESG investing is, well, ESG initially actually stands for environmental, social, governance. So you're investing in companies that actually are doing good for the world. That is one way of thinking about it. So rather than investing in companies that are participating in illegal, let's say, child labor in emerging market countries, things like that. That's just one example. That's one thing. A lot of another hot topic right now is like climate change, which companies are doing good for the environment and not investing in those that aren't. Another buzzword that kind of goes along with ESG investing is impact investing. So it's almost buying into companies that may not be doing the best things, but you're buying into these companies in order to have shares in that company and vocalize your opinion to make sure the company does make good decisions. And all of this ties into the fact that the ideology that if you're investing in companies that are doing good things, this actually leads to higher profits and returns, not only for investors, but for us in the world. Another very common form of ESG is almost exclusionary, where you're just not investing in companies that, let's say, sell tobacco or gun stocks or gambling, anything like that. That's another form of ESG, I would say. And as Pat mentioned, there's so many products out there right now. It is a hot topic. So, and like I said, there's so many different definitions of it as well. So if you are interested in that form, I would say do your research, as Ahmed mentioned, look into the different, let's say, ETFs or mutual funds, whatever it may be, and and see what that ETF's definition of ESG investing is, and what ESG means to that company. And if that aligns with what you're interested in, that's something that you can vocalize to your advisor and say, you know, I want to be investing in ESG companies or ESG ETFs or mutual funds, whatever it is. Or if you're doing it yourself, make sure, as I mentioned, you do that research and you are looking up exactly what that ETF invests in and what the strategy is.
Great.
Yeah, I would add, so when you look at, I'm just gonna pull myself. I think the big thing about ESG is that, yes, it's a buzzword. Yes, it's out. Yes, every company has started to launch ESG products, and it's kind of nice to see this whole kind of evolution. But when my parents were investing, or even when I started investing early in my career, the first thing you kind of thought about was what are your time horizon, what are your goals, and how much do you want to make, or what are your perspective on it? And then try to figure out like, well, but we can do 5 to 8%, or depending on how much risk you take. But they never asked you how you felt about it. They never asked you, how do you feel about what companies we're going to invest in to get you there? And I think that's what ESG has done to kind of people, is like make you kind of feel that, are you okay that we're going to invest in gun companies to get you there? And that's where kind of Veronica kind of alluded to, and you're like, well, actually, I don't like that. And this is where kind of ESG has come in. The problem with ESG is that everyone's definition and how they feel about investing is different. And so an E can be very small, but the S and the G can be very big. What that means is that the company may spend a lot of time on governance, like trying to get a board diversity. They're trying to make sure that there's good hiring practice, making sure that they have a white force that's very demographic in terms of the type of people they hire. And then there's some oil companies that may have a large S score, but their E score is really bad because they know that they're an oil company, but what are they doing on this other side? Well, they're actually planting trees when they're cleaning up and going through the areas where they're mining, or where they're mining for the oils, or they're digging in those areas. So the ESG it's a very broad concept, as Veronica kind of alluded to. But I think what it is that it's made people think a little bit about what they want. And what has happened is that the new generation of investors are actually putting a lot of pressure on government. They're putting a lot of pressure on boards. They're putting a lot of pressure on companies to say, well, wait a second. Yes, my goals are 25, 30 years away, but I actually do want to make sure that the companies I invest in has a gender diversity on the board. I want to make sure that there's women represented. There's different there's people of different race represented on the board. So that's something that's very important, because I want a diverse aspect of people. I want them to also be socially conscious of what they're doing. For example, Elon Musk is an example where his E score is quite high because he is electrifying the world with his cars, but its S and G scores are very low because, like, as you know, he's on Twitter and he tends to talk very openly and how he feels about certain aspects, and the social part is very low and the governance may be lower. But again, so it's very hard. But I think as Veronica mentioned, is that you got to put when you crank up the hood of a car that you're buying and you want to look at the engine, you got to look at the engine for each of the investments and see, does that ESG mean something to me? And that could be what you look at when you're doing your kind of due diligence.
I would think I'd want my advisor doing that. That sounds like a lot. So we've had a question come in that says, what can you advise about international investments? So if they want to invest in various countries. So Ahmad, we'll start with you and then we'll go to Veronica. So if somebody wants to invest globally, how would they do that?
Yeah, I mean, so most mutual fund companies, ETF providers will have a international or global strategy. There's three ways you can play it. There's a passive way of doing it where you're buying broad exposures to the marketplace. Most ETF companies or most mutual fund companies should have a passive version, so that means that you're just getting broad exposure to the market. They're not doing any fundamental analysis, which means they're not going into each country and figuring out what is going on at the government level, the political level, the stock level. They're just looking at exposures to give you exposures that have the largest market capitalization, which means the companies that are the biggest will get the largest representation within that broad-based index. So that's passive. Then there's smart beta. Smart betas are rule-driven. So think of smart beta as a smarter beta. I mean, depending on how you look at it, that's why it's called strategic beta, where essentially it could be rules-based, which are either quantitatively driven or fundamentally driven. What that means that you want to buy a mandate of Europe, but you want them to have a slight tilt towards companies that pay very high dividends, or that have a very high quality score, which means that they're good companies with very good, strong balance sheets, and they have a lot of cash on their books. So they tend to have less volatility in when markets are volatile, because they can kind of weather the storm better. So those are more quantitatively driven strategies. They're priced a little bit higher than passives, because passives giving you just broad-based exposure. Smart beta is adding some filters. Maybe they have stocks that are lower volatile, or they have stocks that are higher quality, or they tilt towards small cap companies that are smaller than the bigger companies. So those are the smart beta side. And the last side is active management, where if you've purchased mutual funds in the past and you've purchased a global manager, then you're paying a manager to go out and find those companies that are doing extremely well within the international markets, and you pay them a fee. That fee could be significantly higher or a little bit higher depending on which mandate you choose. But if you want to invest, then this comes back down to due diligence. You have to look at which, usually Morningstar will go in, or Globe Fund will help you go in, and you can rank the highest to lowest performing mutual funds or ETFs based on an international category. And then from there, you can figure out what do they do differently from others. Maybe that global mutual fund or ETF was invested in oil stocks, and as you know, oil prices went through the roof, and that's why they're doing better than their peers. So you have to look inside what caused them to do better than the other. But international investing is just as easy of doing a US or Canada, but there's still a lot of work that needs to be done to figure out which one do you want. And then if you add the ESG screener on top, it makes it a little bit more difficult, because then you're going to say, well, do I want to buy international companies that have no oversight? Because different countries have different oversight rules. While the US and the European Union and Canada are a lot more, I mean, you pretty much have to have certain rules to do that. So that's another variable that you may want to add in. So it's as easy, and it can be as difficult, but it's a way you can do international fairly easy, but if you know what product you want to buy, and then you just kind of go to your advisor, or you do it yourself through a discount brokerage.
Veronica, do you have anything to add to that?
Sorry, I was just trying to find the mute button. Yes, actually, two things that I would add. So the first is, if you are investing internationally, just be conscious of any potential tax implications, because some countries do have withholding taxes. or additional fees or stamp tax duties, things like that. So just be conscious of that, of whichever country that you are buying stocks in or what the underlying mutual fund or ETF is. The second thing I would mention is, and Ahmed kind of mentioned this as well, but as you're looking at these products, the biggest thing with international investing, or the way it's split up, is developed versus emerging market. Other than the fact that it's often split up Europe, Asia, Latin America, whatever, a lot of the time it'll be split up developed or emerging market, or maybe a combination of both. That's just splitting up almost the riskiness of the investment. Developed market countries, as in the name, they're developed, they are lower risk, but they are also lower growth, versus emerging market countries or developing markets. They're more rapidly growing, but there are a lot of risks involved, given that they aren't fully developed countries. So there may be a little more political risks, tensions in that way. And then you also want to consider the currency fluctuations or the currency risks, depending on the country that you're investing in. A lot of ETFs and products out there come currency hedge, so that they are hedged to the Canadian dollar. So you'll barely see the impact of the currency. Some come unhedged, so you will see impact of the currency. And this goes for the US investments as well. And then there's also variably hedged products, which the portfolio manager is actively deciding on when to hedge and when not to hedge, and how much percentage of the portfolio that they're hedging the currency, depending on things such as interest rates, the actual technical analysis of the currency charts, things like that. Many other considerations that they're taking in when they're doing the active management. So just a couple more considerations with international investing, but as Ahmed mentioned, it's just as easy as investing in Canadian or US companies, but a little more consideration and risk for you as an investor in Canada.
Great, thank you. And we're nearing the end, and there's not a lot of questions to come through. I would like both of you just to speak to, with all of your experience in the industry.
I think there's a question that came in.
Just look at that.
Yep.
Any information is money. I was wondering how much advice I would get from bank investors. That's a politically loaded question, but
No, I think you'd
who
get the
wants to go
same.
first?
Yeah, I can take that. I mean, I started my career as a financial advisor within a bank. I mean, I was forthright with my clients. I worked very closely with them. I held them true to my heart. I was invested in their growing their fortune that they had. So I think it's all about, like I said, you have to interview the right person to do the job, to take care of your money from that perspective. And yeah, I mean, they're going to do, the only thing I couldn't do is I couldn't be as sophisticated as someone that had more money, just because I didn't have the tools. I could do the same financial planning. I could still do the estate planning. I could do, but the type of products I was using was very closed in terms of how many products I could choose. So that's the one thing. I mean, I couldn't use competitor products. I couldn't use ETFs. I couldn't use stocks. I couldn't use bonds, but my heart was there. So from that perspective, I would tell you that it'd probably be the same. It's just that you're limiting yourself to how much you can get access to.
Right.
I think this question kind of also goes to the benefits of interviewing your advisors and making sure that who is managing your money is actually someone that is financially literate. I mean, you could have people that are working in the banks, but they're really just familiar with the actual bank products. Higher tiers of advisors, or maybe those that actually have more of a financial background, could probably offer you more advice. And that's where you actually interviewing these advisors, that'll, answer that question. And as Ahmed mentioned, those working in the banks, some of them, depending on the tiers, some of them offer more services such as tax, retirement, and estate planning. So I know not everyone in the bank is a tax expert, but they do have some people that are working there, or different divisions of their wealth management that do offer those services. So again, make sure you interview your advisors, that if you have more complicated investments or financial goals or anything like that, as I mentioned, those that are self-employed, may need more tax planning and things like that, and may also need more retirement planning as well, because you don't have the benefit of a company retirement plan. So,
and I would add one thing in historically, and I don't think it's changed. It's more important that you're making the investment, especially on a monthly basis, and that you're in the right asset allocation than the specific products, right? I think what an advisor does, whatever level, is it holds your feet to the fire. It makes you invest, and that's the most important thing, right? It's keeping you honest and maintaining your goals. Okay, no more questions. So with your experience in the industry and the companies you work for, what are one or two pieces of advice that you would give people that are new to the Canadian investment landscape that you think would be top of mind? And I'll get to the question that just came in. So Veronica, maybe start with you. What one or two things that you would want to make sure somebody does, or advice you would give before anything else?
So tying back to my last answer, the companies that you work for, if you're not self-employed, will often offer a retirement savings plan option, or a company stock option plan, or whatever the terminology that they use. But essentially, they will be taking some money off of your paycheck and matching that money and putting it into a savings account. So I would definitely say take advantage of that. That's something that I did. I remember I had my first part-time job, and I was amazed with years later how much money I actually saved, just because I was, saving money outside of my take-home pay. So I wasn't actually touching that money or thinking that it's there. But my company was also matching that. And depending on the company you work for, they may match it a certain percentage. I know sometimes the maximum is 5%, but you can invest up to 10% of yours. They'll only match 5% or whatever it is. They may also offer better pricing on their company stock, or depending what the company is, may offer better benefits in that sense. So definitely take a look at your company's benefit plans and take advantage of them as much as you can.
Ahmed?
Yeah, I would agree. It's something that sometimes you're so flustered with the new job that there are great HR packages that come with the job, just to kind of incite you to work and be a part of this new family, of this new company. And they do tend to offer that. So I think that's something that's very important from that perspective. I don't have much to add on that. I think that's it's pretty much just make sure that you see what options are available to you when you're working, because I know some will have great matching programs. I remember when I worked at my previous job, it's their matching program was unknown. I was wow, this is, and then once they figured out that they're giving us too much money, then obviously it got cut. But there are things that you should take advantage of that sound outrageous. I would just jump on it.
And I guess too, because some of the programs that you mentioned, Ahmed, during the webinar about sort of almost free money from the government, that you don't want to leave that on the table, like the RESPs and things where the government wants to match.
Exactly. And I think that's another one where, you're looking to buy a house and they're trying to help you, give you your money back, but then you can put it back. So that's something that's very good. A 20% match on your up to $2,500 is great. That's free money that you can give to your children. So that's a way the government's trying to incentivize you to use the programs that are available to Canadians to invest in your kids' future, to make sure that you don't have those stressful times when the kids go to university, or your daughter, your son, and all of a sudden you don't have enough resources and you got to take out loans and so forth.
Been there. You don't want to do loans for school. I don't have any questions. Do either of you have any final comments that you would like to leave the audience with before we close out?
Yeah, I can just quickly. As I mentioned to you about, we spend so much time doing research on things that matter so much at the point in time in our lives, but we don't do enough research when it comes to our financial future. And I think that's something that's important. Spend as much time as you're looking for that new car, that new house, that new TV that you're looking for, or whatever that's the most special thing, or that vacation you're planning. I mean, we spend so much time trying to figure out the best vacation, but are we doing enough for us to figure out what we need to finish with when we want to retire?
Totally agree.
I guess I can
Anything, Brenna?
add something as well. Just by way of knowing how my friends invest or how they look into stuff, and also tying to Amit's point, like, you should be doing the right research. And if you're not comfortable investing yourself, definitely get a financial advisor. As I mentioned as well, you don't perform your own root canal, you don't fix your own car, you go to a professional for these things. So if you're not comfortable, if you don't understand, it's not even just about looking at the investments, it's also understanding like the market, the economy, like things that actually can affect different investments. That's also something that, other considerations as well. And when you are looking at investments and when you're doing research, we don't mean just look at which ones have been the highest performing ones for the last year, because that's not the best way of doing the research. So or sitting on Reddit forums and seeing what everyone else is telling you to buy. That's also doesn't usually work in everyone's advantage. So yeah, make sure you're doing the right research and reach out to, different financial advisors. And there's so many other investment clubs or other financial education courses out there. Just make sure you're doing the right research.
Thank you. And thank you, everybody, for signing in and staying with us on this webinar. And I look forward to seeing you again in 2 weeks. Thank you, Veronica and Ahmed. This has been great.
Thank you.
Thank you. Thank you, everyone, for attending.